It's one of the most exciting areas in the market, but it's having a real significant pullback right now. The question for investors is, could this downturn be the start of a turnaround? Today, I want to talk about 3 different ways to invest in rare earth minerals. It's a big topic that started to gain traction about a year ago and reached the highs we saw toward the end of last year, but much of the sector has been in a downtrend for most of 2026. This is a case where the stocks got ahead of the story. Rare earths will certainly be a sector that investors will be watching for the next 3, 5, or even 10 years, but the stocks were a bit long in the tooth, and they've been seeing a nice pullback. That's an opportunity, actually. Rare earth metals are a group of 17 special metallic elements with unique magnetic, optical, and conductive properties. The key for investors to grasp is why the sector has emerged as such a powerful investment theme. You'll find these metals in just about everything that powers today's economy: defense systems, AI and semiconductors, electric vehicles, wind turbines, and even cell phones. And that's why these materials have become so important. You simply cannot have a modern economy without them. It is generally accepted that rare earths are only found in China. This is more fable than fact. In fact, many countries have rare earth deposits, including the United States, Canada, and Australia. It's not where they're mined, it's where they're processed. That's the bottleneck. It has taken China decades to build the infrastructure to convert these materials into forms that can actually be used in all of these critical applications. There are people that want to buy into things like this for the long term, but the second you see the market get overheated or have a pullback, they decide that they want to get out. That's probably not the best approach. This will be a story that takes time to unfold, and there will be ups and downs along the way. And there will be periods of volatility that investors just have to be willing to ride through. If you buy the structural investment case, that these metals are required for the economy to work, and that the US and other countries are aggressively trying to build domestic mining and refining infrastructure, then you should realize that the long-term trend is likely to be up and to the right. The question is not whether the trend exists, it's a question of where you come in and how you want to get exposure. That's one of the reasons exchange-traded funds, or ETFs, can make a lot of sense. Mining companies are highly specialized operations: gold, uranium, or rare earths. There are quite a lot of complexities for investors to get their heads around, and if you don't have the time or expertise to look at individual companies, picking the right stocks can come with a much higher degree of risk. And an ETF helps solve that problem because you're essentially outsourcing a lot of that due diligence. Rather than putting your money into 1 or 2 companies and hoping you pick the right ones, you are investing in a basket of companies, which gives you diversified exposure to the industry already. I think with rare earths, the benefits of that diversification outweigh the risks, because the idea is to get some exposure to the theme as a whole and minimize the risk of one bad stock pick seriously damaging your returns. The first ETF you might want to consider is probably as pure a way to invest directly in the mining, processing, and refining of rare earth metals. That's the VanEck Rare Earth and Strategic Metals ETF, ticker REMX. The fund is the closest thing to a pure play on this theme, tracking a basket of global companies involved in mining, refining, and recycling rare earth and strategic minerals. This is a market cap weighted ETF, and it only has 38 holdings, which is not a lot. Many ETFs have 50 or more stocks. The largest holding is Albemarle, at roughly 7.2% of the portfolio. The fund has $2.4 billion in assets under management and a net expense ratio of 0.58%. It's not especially cheap, but it's about what you'd expect from a niche ETF focused on a sector like lithium. The ETF is still up just over 65% over the last 12 months, but what has really caught investors' interest is the sharp pullback of about 22% over the last 3 months. Some investors see that and say to themselves, have I missed the opportunity, or is now really the time to buy the dip? Interestingly, the ETF still trades near the middle of its 52-week range, despite the decline. That's not to say the investment thesis is different. It just means stocks were overbought and have corrected. This may just be a good entry point instead of trying to time the absolute bottom, as you are buying well below the highs and still getting in on the long-term opportunity. Of course, nobody can time the market perfectly, and these stocks could very well go lower from here. It's a multi-year investment story, and we're still early. If you believe the US and other nations are serious about bringing more of the rare earth supply chain back on shore, then you have to pick an entry point at some point. Then, as time goes on, you can adjust your exposure, whether that means adding to your position on further dips or just letting your investment grow with the trend. Approximately 20% pullback is a fair opportunity to start building that exposure. The second ETF is the Global X Rare Earth and Critical Materials ETF, EART. This fund's approach is a little different. It is more application-oriented than the extraction and refining of rare earth materials. Still exposed to mining, but it invests in companies that make the components and raw materials that go into electric vehicles, energy storage, robotics, radar systems, and other advanced technologies. And it's more on the industries that actually use those materials rather than on the supply chain itself. Some of the bigger positions are Freeport-McMoRan, Southern Copper, Albemarle again, and MP Materials, which is one of the more direct rare earth companies out there. That gives investors a bit broader exposure, but still tied closely to the applications driving long-term demand. REMX has 38 companies. This ETF has about 50 companies in it. It has about $40 million in assets and an expense ratio of about 0.59%. So it's pretty similar to the VanEck fund. More holdings, so no one company controls the portfolio. The largest stake is held by Anglo American PLC at around 5%. Well, there's one way to spread the risk, but critics would argue it also caps any upside potential. But investors tend to buy ETFs because they want to minimize risk, not maximize returns on some individual stock. Another choice is the Sprott Critical Materials ETF, ticker symbol SETM. This fund provides a lot more exposure because it invests across the broader universe of critical materials, not just rare earths. At any one time, it typically holds between 125 and 170 companies, by far the most diversified of the three ETFs. The fund has about $541 million in assets under management and an expense ratio of about 0.65%. And that's a little higher than the other two funds, and some investors may not like paying a higher fee. But that's not too far from what you would anticipate from an ETF covering such a broad and complex basket of companies. What matters is that the stocks are ahead of the story. The case for rare earths remains the same in the long run, just as it does for other new areas, such as space exploration. In both cases, investors got carried away, valuations got stretched too thin, and then the stocks fell back. That's pretty typical to see when investing in long-term growth themes. If you want to get exposure to an ETF, buying after a significant correction when prices are in the middle of their 52-week range rather than near the highs could be a much better opportunity. Yes, prices may well drop further, but the more important thing is you are entering well below the peak instead of chasing momentum. These are long-term themes whether you're investing in space, rare earths, or some other emerging industry. The story is still being told. It's very tempting to sell during volatile periods, especially when many of these companies are in relatively early stages and institutional ownership isn't all that high. That naturally means bigger jolts. My best advice is to know what you own. You don't need to be a professional or lifelong industry expert to know what you own. It's simply a matter of doing your homework on the industry you are investing in. You can learn about space, you can get to know the rare earth. But if you don't understand a sector and you don't want to learn about it, then you're probably best off not investing in it. There are always opportunities in the market. You don't have to be in every sector to be a successful investor. If you don't like mining stocks or rare earth companies, that's okay. Do not touch them even if it means missing out on some possible gains. There are lots of other ways to make money in the market. Thanks for watching. Please subscribe to this channel.